PDD Holdings is a Chinese company formerly known as Pinduoduo. It operates an e-commerce platform called Pinduoduo and Temu, an online marketplace. It is growing in such an incredible pace that just recently it became the most valuable e-commerce company in China, beating Alibaba. So let's take a look at this company, let's analyze it, value it, and see, can it be an interesting investment opportunity? If we look at the recent results, we see that revenue is up by 93.9% year over year, net income is up by 46.7%, cash is up by 60% in 9 months, and debt is up by 3% in the same period. So, like I said, the growth is exceptional. But we have to remember that it is a new company. It was incorporated in 2015, and that we have to look out not to be fooled by short-term results. So let's step back a bit. If you were to invest $1,000 into this company at its IPO in 2018, you could buy around 52 shares. And now they would be worth something close to $7,511. And that is a gain of 651% since 2018. That is incredible. But of course, future results don't have to look anything like the past results. So let's not concentrate on the price of the stock, but instead, let's take a look at the company itself. Individual insiders, that is a check. 33.6% of the company is owned by individual insiders. Almost all of that is owned by its founder, Colin Huang, who is currently the 3rd richest man in China. And are individual insiders buying? That is an X. We don't see any transactions from individual insiders. And do super investors own this company? That is a check. There are 3 super investors: David Tepper, Robert Vinal, Chase Coleman. And I recently made an analysis of David Tepper's portfolio, so if you want to check it out, the link will be at the end of the video. And are super investors buying right now? That is a check, or 3 of them are buying. And in the last quarter, they bought over 2.2 million shares. Return on invested capital, that is an X at minus 13.6% median returns. So that seems like a red flag. But the reason for such a bad result is that Pinduoduo is only profitable since 2021. It is a new company. It went through a period of heavy investing and growing. And finally, it got to a scale that allowed it to become profitable. If we look at return on invested capital in 2021, it was 9.6%. And in 2022, it was 27.4%. So the trend is very positive. And free cash flow growth? That is a check at 94% annual growth rate since the creation of the company. So that is an incredible result. And what do we know about net profit margin? It is a check at 23.3%. And that is another impressive result. Because when we look at the competitors, we see that Alibaba has a net profit margin of 14.5%, Amazon 3.6%, JD 2.2%, and Coupang 1.9%. So Pinduoduo has a lot of pricing power at the current moment. And now let's take a look at share buyback. It is an X. Since the IPO, they issued 48.4% new shares. That is very bad. But maybe they did it so that they could grow, but at the same time keep their debt low. Well, let's find out. It is a check. Pinduoduo has almost no debt. So that was their strategy. Instead of getting into a lot of debt, they preferred to issue more shares and get financing that way. And now that the interest rates went up, this strategy may pay off. Pinduoduo is currently experiencing rapid growth as it expands its operations. The company wants to use its available resources to further increase its size and take advantage of the economies of scale. This explains why they are not currently paying any dividends. And it's likely they will continue this approach as long as they will find new opportunities for growth. Price to earnings ratio is 33.1. So it's pretty expensive, but at the current market, a lot of companies are expensive. The average PE for the S&P 500 is around 25. But to properly value this company, we will be using a discounted cash flow formula. We will estimate the growth of Pinduoduo for the next 10 years, and we will make 3 scenarios of this growth. So in the low scenario, we will estimate a growth of 4% for the first 5 years and then 3%. In the medium, 8% and then 6%. And in the high scenario, 15% and from year 6, 10% growth. So why did I use such estimates? Well, there are a number of reasons. First of all, the Chinese economy is predicted to grow by 4.1% in the coming years. So that is basically our low scenario. In the medium scenario, we predict that this company will grow twice as fast as the Chinese economy. And if we look at the e-commerce market worldwide, it is predicted to grow at a rate of 13.6%. So that is closer to our high scenario. Of course, we could just take the average annual growth rate of Pinduoduo, and we see that since the company was created, its revenue went up by 152% per year, and free cash flow by 94%. But honestly, such growth is very unlikely. We should take into consideration that as the company becomes bigger, its growth should slow down and get closer to the average of the market. So maybe I am too conservative. But if the first rule of investing is never lose money, then I prefer to be on the safe side. So with such estimates, the intrinsic value in the low scenario is $128, in the medium $164, and in the high scenario $244. But that is not the end, because we have to also apply a margin of safety to those prices. I use a 30% one, and such a margin is even more necessary in case of a Chinese company. Not only because of the international tensions, but also because the Chinese government has the power to destroy or at least change any business with just one decision. So we have to take that into consideration before making any investment decisions. And with such a margin, we get in the low scenario $89, in the medium $114, and in the high one $171. And the current price is around $146. So it seems that Pinduoduo is close to its fair value at the moment. Not quite there, but close. When we look at the intrinsic value, it's worth noting 2 things. One is that just 4 months ago, the price was below the low scenario with the margin of safety. And since then, the stock has gone up by 87%. So we are just after a meaningful change in price. And the second thing is that super investors were buying when the price was below $100. So that is around the low and medium scenarios with the margin of safety. So I believe that after the recent change in price, it is somewhere close to fair value. But the net profit margin, which is way higher than most of its competitors, can be a very strong indicator that this company has some serious potential. But just as with Alibaba or Tencent, we have to understand the risks of owning a Chinese company. And if you found this video interesting, you may want to check out my analysis of Alibaba by clicking over here. Thank you so much for watching, and see you in the next one.